Tax and legal considerations for second home ownership. Owning a second home or vacation home in the United States of America can be both very enjoyable and a smart investment. However, it also creates some serious tax and legal considerations, which we will start to draw your attention to in this introductory video. Determining tax status based on personal use. The Internal Revenue Service, IRS, categorizes second homes differently depending on how frequently the owner uses the property versus how often it is rented out. The most critical threshold is known as the 14-day rule, which dictates that if a property is rented for fewer than 15 days per year, the rental income is generally tax-free and does not need to be reported. However, if the property is rented for more than 14 days, the owner must report the income, and the tax treatment of expenses changes significantly based on personal usage. If an owner uses the home for more than the greater of 14 days or 10% of the rental days, the property is considered a personal residence, limiting the ability to deduct rental losses. Conversely, if personal use is kept below these limits, the property may be classified as a rental activity, potentially allowing for more aggressive deduction of operating expenses against income. Deducting mortgage interest and property taxes. For many buyers, the ability to deduct mortgage interest is a primary financial consideration, but the Tax Cuts and Jobs Act of 2017 introduced specific limits that apply to second homes. Taxpayers can generally deduct interest on up to $750,000 of combined mortgage debt for their primary and second homes, provided the second home is not classified purely as a rental property. If the total mortgage debt exceeds this cap, a portion of the interest will not be deductible, which can significantly increase the after-tax cost of carrying the property. Additionally, state and local property taxes on the second home are subject to the same $10,000 annual cap that applies to the primary residence. This means that for owners in high-tax states, the property taxes paid on a vacation home may offer zero additional federal tax relief. The complexities of capital gains tax. When it comes time to sell, second homes do not automatically qualify for the favorable capital gains exclusion available to primary residences. While a primary home seller can typically exclude up to $250,000 or $500,000 for married couples of gain from taxation, a second home sale is usually subject to capital gains tax on the entire profit. To bypass this, an owner would need to convert the vacation home into their primary residence and live there for at least 2 of the 5 years preceding the sale. Failure to meet this use test results in a long-term capital gains tax liability, which can be as high as 20% depending on the owner's income bracket, plus potentially a 3.8% net investment income tax. Owners must meticulously track capital improvements, such as renovations, to increase their cost basis and reduce this eventual tax burden. Estate planning and ancillary probate. From a legal perspective, owning real estate in a state different from one's primary residence can complicate estate planning by triggering a requirement for ancillary probate. This means that upon the owner's death, their estate may need to be administered in the courts of 2 separate states, leading to increased legal fees and administrative delays. To avoid this, many owners choose to hold their vacation homes within a revocable living trust, which allows the property to pass directly to beneficiaries without court intervention. Additionally, if the property is intended to remain in the family for generations, a more complex structure like a qualified personal residence trust or a family LLC may be necessary. These structures help manage how the property is shared among heirs and can define rules for maintenance costs and usage schedules. Liability risks and asset protection. Owning a second home, particularly one that is rented out or frequently hosts guests, introduces significant personal liability risks that standard homeowners insurance may not cover. If a guest is injured on the property, whether in a swimming pool, on an icy walkway, or due to a maintenance failure, the owner's personal assets could be targeted in a lawsuit. To mitigate this, owners often increase their personal liability coverage or purchase a dedicated, umbrella insurance policy that offers higher limits of protection. For those who rent their properties significantly, holding the title in a limited liability company is a common legal strategy. This structure effectively separates the vacation home from the owner's personal assets, ensuring that a lawsuit related to the property is generally limited to the assets within the LLC. Rental income reporting and passive activity rules. If a vacation home is treated as an investment property for tax purposes, owners must navigate the passive activity loss rules. Generally, losses generated from rental real estate are considered passive and cannot be used to offset active income, such as wages or business profits, unless specific income requirements are met. However, there is an exception for active participants with a modified adjusted gross income under $100,000, who may deduct up to $25,000 of rental losses against other income. As an owner's income rises above this threshold, this allowance phases out completely, leaving many high net worth owners unable to utilize rental losses until the property is sold. Therefore, high-income earners should view a rental vacation home primarily as an asset for appreciation or cash flow, rather than a tax shelter. Local regulations and zoning compliance. Beyond federal taxes and general liability, owners must be acutely aware of local zoning laws and homeowners association rules that increasingly restrict short-term rentals. Many municipalities, particularly in popular tourist destinations, have enacted strict ordinances that cap the number of rental nights or require expensive permits and business licenses. Violating these local statutes can result in steep fines and legal action, rendering a planned rental strategy inviable. Furthermore, homeowners associations often have the power to ban rentals entirely or impose minimum lease terms, such as 30 days or more. It is legally imperative for buyers to review the property's deed restrictions and local municipal codes during the due diligence phase to ensure their intended use of the property is lawful. We welcome you to learn more about our law firm's international legal practice. We welcome you to visit our website or contacting our law firm to schedule a confidential initial consultation. Thank you.